Welcome back to this series on what you need to know to get started in the stock market. And we've previously looked at some of the principles around smarter investing. And in this video, I want to take a look at some of the key principles of trading effectively in more of a shorter term to medium term trading environment. So the first real key is that you've got to try and get in at the start of a new trend or during the continuation of an existing strong trend. They're the very best times to be entering into a particular stock. It's certainly not at the top when everyone's bullish and rumors are flying around about how great this particular stock is. That's almost always the worst time to be doing it. Yet it's when most people kind of feel most comfortable doing that. So how do we know when a trend is starting or is finishing? And that's really the subject of this particular video. So what I want to have a look at first is something called phase analysis. Every stock and every market goes through certain cycles, and there's really 4 cycles that you can identify, which is really just about crowd behavior and human psychology. And because of that, it has to play out the same way every time. And stocks act in very different ways, and they have very characteristic ways in the varying phases, and that's according to the supply and demand for people wanting to buy or sell the stocks. So if you understand what those characteristics are, it's very easy to identify what phase you're in, and therefore to have a pretty good idea of where the actual trend is and whether it's a time to buy or sell or just in fact watch. And as I said, the price action must play out this way every time because it's just human psychology. Now, phase 1 is what we call the basing phase, and this is the phase that comes just after there's been a very significant fall in the share price over a lengthy period of time. And at this stage, supply and demand is roughly equal. You've probably still got a few people wanting to sell, and you've got some smart money starting to buy, but they roughly equal each other. So we end up with a fairly tight price range, and most people lose interest during this period. If it's when the market as a whole is down, then no one's talking about stocks, no one's interested in stocks, and this is often when some of the really best trends are just starting up. Trading volumes are pretty low at this stage, so that's another indicator of that phase 1 basing pattern, and we'll have a look at an example of this shortly. So the message is that the worse that sentiment becomes, the more interested you should become in looking for the signs that we're maybe moving out of a phase 1 base and moving into a new phase 2. So phase 2 is where new bull markets start, and they start because demand to buy the stock starts to overcome the supply or the number of people selling. So the smart money starts buying in first, and when there is no more shares to be picked up at that low price, they've got to start paying higher and higher prices, and so as a consequence the share price starts to rise, and it's really as simple as that. And prices tend to break above the resistance barrier that's been enforced during phase 1, and what we get is new highs and also higher lows. So that's the definition of an uptrend: higher highs and higher lows. At this stage though, it's not easy to get into a stock in the early stages of a new bull market because the news is generally still poor, and most people are still either not watching or they're very skeptical that the share price is going to go up a little bit and then it's just going to come straight back down again. So it's not necessarily the easiest thing to do. Now the bull market then proceeds for quite a period of time generally, and as always it gets overvalued because the human psyche is that we all tend to want to get in at the end, and we push the price up and it becomes overvalued. So then we move into phase 3, which is the topping phase, and there's often an absolute buying frenzy going on up here, and people can't buy enough of the stock and they're just falling over themselves to pay any old price. But the educated money recognizes that the stock is overvalued at this level, and they start to sell into that buying strength. So as a consequence, we see some wild swings in price that weren't evident in either phases 1 or 2. So that's the first indication that we're probably entering into the phase 3 topping section of the market. And then finally we move into phase 4, which is the liquidation phase, or the bear market phase of the market. And prices start to fall sharply during this stage. Now initially most people don't believe that the trend upwards is going to finish, and so there's always a certain element of the market is going to keep buying the dips, and it's generally the less experienced traders that keep trying to find a bottom as the price goes further down. So phase 4 bear markets begin on hope, and hope fades as the prices go lower and lower. The hope turns into despair, and then finally the despair turns into panic. And the phase 4 finishes when basically the selling is all done, when there's just no sellers left. And invariably the price has gone too far at that stage, and the stock is particularly undervalued at that point. And phase 4 liquidations have little regard for value, and this is when you can sometimes pick up some terrific bargains. So how do we actually go about identifying the phase? Look, I use just a few simple tools. One of them is just a simple 150-day moving average, and we just look at the price action that is surrounding that. So let's take a look at an example. And this is JB Hi-Fi that we looked at in a earlier video, and I'm just going to advance this month by month. So what we're looking at here is the phase where this is phase 2 that ran from early 2009 to September of 2009 at this stage, and you can see that the price is rising very, very strongly, and it's well above the 150-day moving average, way above it. So let's just advance the price month by month. So we're still rising at this stage. Price is up to about $20. Now it's up to about $23, and you'll notice that there's very little pullbacks in price along the way. It's just a very steep incline, and the price is way above the moving average. Now at this point it's become a bit overvalued, but most people don't see that because it's a real market darling. Now the share price starts to come back a little bit, and you can see it's starting to close the gap on the 150-day moving average, but still well and truly above it. So still no problem at this stage, and there we go. The people have been buying the dips around $19, $20, and the price has started to rise again. But then we get to a stage where the price is really going sideways, and you can see now we're just about for the first time to cut through that 150-day moving average. So that's really our first indication that that we're going into a phase 4. Now the price continues to drop for a considerable period of time. So as we advance through the months, you can see the price is now down to about $11, and it's now consistently below the 150-day moving average, and it's plummeting sharply. Now it goes into a phase 1 base down here, so we based out around about $8, and we stayed there for a few weeks, and now we're starting to head back up again. And it's not until we get to this phase up here that we've really got some confirmation that we've got a new uptrend in place. So we just continue that particular chart on, and we can see that that there's been an enormous recovery into phase 2. So the key takeaways here are that the higher the angle of the moving average, the stronger the trend. So that's the thing to look for there. Now the other key point is that most people didn't really believe the rally for 4 months after the first very obvious signal had occurred. Now in future videos I'm going to be looking at the basic approach between short-term and medium-term trading, and I'm also going to take a look at the indicators that provide a big edge in the market. But the key thing to remember is that keep it simple when you're doing technical analysis. It's very easy to overcomplicate things, and It generally leads to more confusion, leads to over trading, and generally not very good results. So when it comes to trading, keeping it simple is definitely the best way to go. That's all for this video. See you soon. Cheers.